Hello, wise people. This is the Wise Finances Podcast.
In today's episode, we are discussing the truth about our US economy system and how it works. So, today is actually a very informative episode. I might have to break it down to two parts because it might be a lot, but I think it's important to have that foundation knowledge of how our economy works to really understand how you can win and leverage the system. So there's five parts of our economy. The first being money. Money is paper. That's basically what it is. Our federal system, they print it out, but what's attached to that money is a value. So our dollar bill, like the Benjamin Franklin, is $100, right? Uh, it has a value of that amount. So what the economy doing is just print it out, but you earn your value in the world by on what you put into your company, your job, your business, etc. And so whatever you put that value at that price, or whether you are put whatever that value is put at what you earn, your hourly wage, then you can make as much money as you are set, or your skill sets. Like we understand that doctors get paid more money in the United States because their skill set is very unique and it's not easy to duplicate that. So their wages are higher than, let's say, someone who works in a fast food industry as a cashier, because it's easy to replace a cashier than it is to hire and train a doctor. So that is the value of our money. So we see after time that our value of money decreases. So the items that we purchase increases. This is inflation. So that's why we looked from 10 years ago, 20 years ago, the price of gas, the price of food, the price of rent, all has increased because the value is has decreased. So that same $100 bill 20 years ago would give us more, and we can spend more with that than we can today. So what can you do with that your money? There's pretty much two things you can do with your money. You're either buying assets or you're buying liabilities. In this podcast today, I'm really going to focus in on the liabilities, but these liabilities are things that you buy that goes down in value. These are cars, these are clothes, these are vacations. They're not necessarily making you money. That's what an asset is. An asset is something that you pay for that's going to make you more money. So that is the first part, is just knowing about our economy and knowing about money. The next is consumerism. And when I speak of consumerism, I'm just talking about spending money. It is where we provide what our value is at. So if you value dinner and going to that restaurant and placing that value for that $100 meal that you got, you are going to put value in that business by allowing that business to now be able to operate, to have more bit, to have like another restaurant, to be able to pay for more employees. You're adding value to that waiter because you're giving them a tip. So it is basically you spend your money, and it's growing the economy by spending. So the money you earn, you go spend it, and it puts value in a business or someone else, and then they go in return spend that money on something else. So it's literally we're in this cycle of always spending. And consumerism is kind of broke down into these four different layers. So you have things that you're buying for and your necessities. You need this to survive: food, shelter, water. That's always going to be a priority, right? So people will always spend on necessities. Then we have a next layer of consumerism is making people's life easier. You get Apple in the iPhone. The iPhone is an easy device, smartphone that works. You can save your messages. You can go in between apps. You can have your iPhone and your iPad all connect. It kind of makes your life easier. So you are willing to pay that premium price for an iPhone because the value it gives you to make your life easier. Then we have consumerism that makes life cheaper. That means that you can buy things at a cheaper rate. This is why we love Walmart. This is why we love Costco and Sam's Clubs because we are getting a bargain on things that we might find that are necessity, that might make our life easier, but it's for a specific type of person that's looking for a bargain. So someone who's looking to buy clothes at Walmart is not the same person who's looking to buy a clothes at Gucci. The next layer of consumerism is pretty much anything else, which is kind of like your luxury. Kind of goes back to that Gucci example, or someone who wants to buy something just because. It could just be like Pokemon cards, not necessarily a necessity, not making your life easier, not a cheap product. So it's things that we can buy just because it's our desire, because it's our want. So literally companies, businesses are wanting you to spend kind of like in those four kind of categories. Things that are necessities, things that's going to make your life easier, things that are make your life are cheaper for you, or things that are just exclusive. So how can you be able to buy these things? That goes to our third area of how our economy works is credit. So credit allows us to spend more money than what we have earned. We are borrowing on future money that is earned. For example, we can do this with car loans, credit cards, student loans, etc. We are banking on the money that we will potentially get. So it can say, for example, you might have earned $50,000, but you are going to buy a $60,000 car and you're going to get a car loan. And what you're going to do on that car loan is you're going to make a set price and you're going to pay that $60,000 car off with interest plus interest for being able to take that value now, even though you might not have the money to actually pay for. Is credit good or bad? Well, it just kind of depends. If it's used for a liability, no, this is bad. This is a bad debt. This is what most people, what the majority of people do. They take credit to buy things that are not earning them money, that are throwing them, that it can be thrown away. They're throwing away their earned good money to buy things that are not making them money. How is credit good? Well, you can leverage something by buying something that's an asset. And this can be stocks, real estate, a business that is basically you're creating to provide to earn you money. So there's ways to leverage credit. And you want to be able to understand the economy so you're able to know how you can leverage credit in order to make sure you're taking advantage of the system. As a consumer, we are always taught to take buy. That's what we see. That's why there's so much money spent on advertising to convince you to buy something. But it's not the problem on that you're buying. The problem is what are you buying on? So switching that mindset to now spend more of your money on things that are going to make you money, that's going to be an asset. That's how the economy works, is either you are a consumer or you're an investor. And again, the investor is using credit to make money because to basically give yourself an asset and make money off of it. So then the fourth part of our economy to understand is booms and busts, because this just means that the Federal Reserve can manipulate our economy because they have the power to print more money, lower interest rate. So this kind of is going to create highs and lows in the economy. It's going to get people excited, to buy stocks, to buy an asset, or because something happened with this company, speculation. So people usually take advantage, or sometimes people get greedy, and then it creates these times where it can create a bubble. But this bubble only affects people in different ways. So let's take example of real estate. Right now, it's kind of like a real estate bubble. The inventory is really really low for homes right now, so that's driving the prices up. So if you ask a homeowner who has a property, are they excited about the increase in real estate? They're going to say yes, because they already own their asset, they're already locked in their mortgage, so their property going up is a great thing for them. If you ask, on the other hand, you ask someone who's interested to get into real estate, same thing applies with stock markets. When a company's stock prices are rising, this is good for people who already are share owners, who are stock owners. They already have that asset. So seeing that company's prices are going up, that means they're making more money. This is exciting to them. But someone who hasn't yet invested in that company, hasn't bought stocks in that company, it's like they don't like that. They like it when the market is down so they can buy into stocks at a cheaper rate. So it's always gonna, depending on what side you're on, it's gonna have either a good a good effect for one side or a negative effect for the other side. So there's these cycles that our economy goes into. So first we have the economic cycle, which we know in recessions means that, like, this is how recessions are created in economic cycles, because jobs, consumer confidence is not, is worried. People are worried. Um, they're not spending as much money, right? Because something happened, a bust happened. So we think about the 2008 housing crisis, the economy crashed, so there wasn't as many jobs, and so people weren't spending as much. They naturally save when economy comes, because they're unsure of the unknown. Same right now in our 2020 recession, we are through the COVID-19 virus. A lot of people lost their jobs. We had to shut down. Businesses shut down. Usually it comes and goes every 8 to 10 years. Some recessions happen and it doesn't have a big impact. We don't even notice it. But we see usually the economy, the government are doing things to help jumpstart our economic cycle. So you get like the stimulus checks right now. Then you have like an layer of your economic cycles. You have your asset cycles. So these are things that are making you money. So we're thinking about real estate, we're thinking about stocks. It's easy to see. It's very clear that something is evaluated at this price and we can clearly see it's going up, or we can clearly see it's going down. So it's easy to manipulate this. Governments can, we can see like right now with the CARES Act, government bailed out the stock market. So even though it crashed in March, because the government was able to bail out the stock market, we now see a shift, and now we see a high increase in different, in the economy, in different stocks, in different companies going up, their value going up, because assets, can be regulated through our government. Same thing when the 2008 crash happened, and a lot of it was due to the housing, and a lot of people were getting foreclosed because the banks were basically having given out these bad loans that people couldn't afford. Then the government came in, Franny Mae, and they are being able to regulate that. And that's changed like who was getting approved for these types of loan. So even though our assets is a layer of our economic cycles, we see that a lot the government can control this, and it's very easy to see appreciation in something going up, or when or something is going down. Next, You have the debt cycle, which is really hard to track. Actually, they say it's about 50 to 100 years to actually see a full cycle because it's hard to see when interest rates are very, very low and then when they're like at its highest point. So the big first lowest point of our debt cycle where interest rates were at 0% were in the 1930s, and then the highest percent was actually in the 1980s, which was when interest rates were about 20%. When we see when interest rates are lower, that gives consumers, they have the ability, they want to buy more because they are going to pay less in interest. So it becomes, when interest rates are lower, it actually becomes a good thing for economy because what happens is people are more likely to buy more. People are going to more likely go and try to buy a home because they're going to pay less later on for their mortgage or their car loan that they will get. Instead of paying 6, 7%, they can get a car loan for 1%, 2%, even 0% for some, so whatever the terms that they agree with. So interest rates does affect how people spend or not spend. So when interest rates are higher, it's going to make it harder to borrow money. It's going to make it harder for people to qualify. It's going to make it harder for them, for their money to stretch. Right? Think about like a house. If your interest rate was in the 1980s 20%, the the purchasing power you have for a home was a lot less because so much was going to go more to interest than paying down your principal. Well, same thing applies now when your interest rate is very, very low. If your interest rate is low, that means your purchasing power can stretch a little bit because now you're able to afford, your money can go a little bit further and you can afford more because less is going to the bank on interest. The last key thing about the economy to understand is understanding risk. The US economy is the largest in the world. So, because it's so large, it's hard for it to grow quickly. Thinking like a ball, like if you had a ball and you just push it, it's going to be simple to push it if it's small. But if you got this big, massive, giant ball that's bigger than you and you try to push it, it's not going to go far. So, we look at gross domestic product, or you might hear GDP, and you might hear that this term a lot if you're ever watching like the news and they're talking about the economy. Usually they want this to annually grow about 2%, but the higher they can get it to grow, the better. So, in order to really have your GDP to grow, is to keep money flowing in the economy. And how do you keep money flowing in the economy? You have to spend money. So even though, so how do they spend money? Well, how do they get us to spend money during times of recession, during things like that? Well, it kind of goes back to all the key points I laid out. You might see interest rates get cut. You might see stimulus give. You might see cuts on corporations to increase wages, right? So then people have more money to spend. So it's hard to say like one one it spending is the one thing that affects a lot of our in our economy. So if you understand that, to really win in our economy, to understand our economy, you're going to fall in the minority set or you're going to fall in the majority set. Majority of the set, people are spending to consume and consume things that don't give them value, things that is not going to make them money. But if you're going to spend your money on things that is going to grow in assets, going to make you money. And that is your stocks. That's your real estate. That's your business. Those are the things, and there's some more like there's so many assets that you can spend on. and there's so many liabilities you can spend on, but you have to be able to choose wisely. So using your credit wisely, using it for things that can potentially make you money, things that's going to provide for you, your family, and next generations to create generational wealth. So understand, like we're in this society to spend money, but it's about how you spend it wisely, which makes the difference. So hopefully this was informative for you. I think sometimes it's really hard to know what we're doing in this world if we don't know those basics. And that's why I really want to talk about this. Hopefully, this was a little bit more informative than your econ 101 class if you took in college, or if it was even, or in high school, or if it was even beneficial to you then. These are like the key things to like really understand how our economy really truly works, and just think like an investor. Always think like an investor. Anytime you spend, whether if it's something small, think about the value. Think about the value it's bringing to you. Do you want the value to be in the moment, in the present, or do you want that value to still produce for you in the long term, in the future? And those are the truths about our economic systems. Make sure to like, subscribe, download the podcast, leave a rating, leave a review. Make sure to send me your DMs if you have any questions on Instagram at wisefinances underscore. It was great giving you this episode, and I look forward to seeing you next week.
This is the Wise Finances Podcast.